time, the small and mid-cap indices have seen a sharp reversal this month. Portfolios on an average are down 20 to 25% for many investors. The key question we're asking today, is the correction done or is there more to go? Nimesh, you put together some thoughts.
I'll put some data, but of course, Nilesh will be better to say whether the correction is done or there is more to go. Yeah. So what has mid-cap and small-cap done this year? If you look at, let's look at for this year. Y2D, the returns are very, very flat. If you look at Nifty mid-cap, small-cap, or for that matter, micro-cap, just 1% return. But from the peak, the mid-cap index is down 5%. Small cap and micro cap indices are down 10% and 11% respectively. So there has been a big fall. But if you just look, just put into context as to what these indices have done over 2 years and 3 years, that shows a different picture. Mid cap index over a 2-year period has given a 63% return. Look at this, 63% return over 2 years and over 100% return over 3 years. Small cap index in 2 years given 45 and over a 3-year period has given 82% returns at an index level. And micro cap index in the last 2 years has given 86% return. So it's been a big move in these indices in the last 2-3 years. So, but the street seems to be quite divided at this point in time. I've just looked at some brokerage notes. For instance, HSBC, they believe that this correction, what we've seen in March, is unlike to what we saw in 2018. Things have become much more better. The macros are much more better than what it was in 2018. So they do not expect a sharp 20-30% kind of drawdown from these levels. So that's HSBC note. If you look at even Jefferies, even they've put out a note and they believe that the recent correction that we saw is much healthy and not like a meltdown. In fact, they see strong capex makes several mid and small cap attractive at this point in time after the recent correction. Similarly, if you look at the JP Morgan note, even they say that a 5 to 10% downside could be possible, but high exposure to sectors like manufacturing, infra, green energy can offer very high alpha opportunities going forward. So that's the Jefferies note. However, there are some not so bullish notes as well. So Bernstein put out a note a few days back. They believe that valuations are still rich after the recent correction, and it's going to be tough here to create alpha in the broader markets, and they prefer large caps over mid caps. So that's the broad view from the market. I just want to leave with few stocks which have done really well, but the valuations are stretched. So one needs to be careful in terms of stock picking as well. Look at these names: IRFC, REC. IRFCs are 400%, but now the valuation looks quite stretched. So is the case with REC as well. The stock has rallied almost 300%, but now it's trading at close to 1.5 times price to book versus just 0.6 times the 5-year averages. Even if you look at the likes of Hudco, Ircon, and Cochin Shipyard, look at Cochin Shipyard. The stock has rallied 300%, but now it's trading at 77 times on current year PE versus their average of 24 times. So while the broader markets, some stocks may do well, one needs to factor as to where the earnings are going to be strong, because only on valuations, so many of the stocks look stretched and may not bounce back sharply in this challenging year.
Okay, well, Nilesh, your